So this chapter deals a lot about inflation, and it deals with certain of the costs related to inflation. And then towards the end of this class, there's a chapter that deals with the cost of letting inflation fluctuate. So here we're looking really at the cost of inflation. And I'll talk briefly about it. There's also the cost of letting inflation vary too much. There's another cost associated to that. So here when we're talking about cost of inflation, even though we might stay in a 1 to 3% inflation target, inflation range, that is the goal of the Bank of Canada since the 90s. And the target is 2% target, inflation target. These costs here that we're talking about today, that's just a small part of this chapter, but these costs that we're talking about today are relating to any inflation rate that is positive, like 1, 2, 3, 10, 20%. The greater the inflation rate, naturally the greater those costs. But if we stay within that range, we only face the costs I'm going to highlight in this class. But later on, at the very end of this class, there's going to be the discussion of why, if we're going through a recession, we may not want to overstimulate the economy and have 5% inflation. Even though 5% is not that high, we don't want that to happen because it's going to change inflation expectations, and it's going to be very costly to remove those higher inflation expectations. So we want to offer some price stability. This way we have some costs, and I keep on alluding to those costs, but the two main ones are menu costs and shoe leather costs. I'll just define those in a second. But when we have this positive inflation rate, we have these two costs, but if we stay within a range, like even though you could say, well, 1 to 3% is not the exact same percentage, well, if we can keep expectations, people's expectations within that range, we have a situation where we have stable prices, stable price increases. Because the definition of inflation is a general increase in the price level, so if we have that 1 to 3% general increase in the price level, it's still pretty stable. You could think, well, 3 is 3 times more than 1%. I agree, but it's still like we're talking about small amounts. Something that costs $100 today will cost between $101 and $103 normally tomorrow. Or it might not change price tomorrow or next year, or the year after that, but then in a few years, it might go up to 110. And that's kind of related to the whole idea of menu costs. Menu costs, in a simple way, is the idea of printing up new menus every time you change the price. It's all the costs associated with changing prices. So the triangle is always changing prices. So here we can think about menus if you operate a restaurant, but you could also have like website. If you sell online, like if you have to, imagine you're like Rona or Home Depot or whatever, and you have like thousands and thousands of products. And every single product you want to change the price. There might be an easy way to change a bunch of them with the same percentage increase from one year to the next. But if they haven't changed that much and you have to input one by one every single article, it'd be very long. Hopefully, you can hire someone who's able to do it rapidly by using different systems in place, and it's well structured. But you can think of all those things lead to certain costs. You might have business cards, you might have other things that are printed out. Well, as soon as those prices change, there's a certain cost involved. Funnily, a few years ago, I was teaching in snowboarding in Andorra, and in the restaurant there's the menu printed out like on like a plastified paper, and then it was written with kind of like a removable Sharpie kind of thing. So they kind of removed the menu cost idea there, that they could always keep those menus. They just had to kind of clean it up nicely, and then they could put new prices. But most businesses don't operate that way. So there is a certain cost involved, and due to the fact that there is a certain cost involved, when prices increase by 2% every year, you might decide to increase your prices 2% every year, or you might decide to have price jumps. Like if you ever get massage or get your hair cut or other things of that nature, you might see that, oh, for these years, this service costs $30 or $60. And then all of a sudden it went up to 65 or 70. Well, that's way more than the jump in inflation. Like going from 60 to 70 is like a sixth more. We're talking more like 15-ish%. So it's way more than 2%, but if that person didn't increase it over 7 years, it kind of makes sense for them to have such a big jump. Anyways, so that is menu cost. So anytime you have positive inflation, you will have this. If inflation is closer to 1%, naturally you won't feel the need, the urge to update your menus as often as if the inflation rate was 100%. Well, then you'd really want to update them frequently. And if you think of hyperinflation, the situations where prices are just out of control and increasing at a very alarming rate, well, in that situation there, with hyperinflation, you'd constantly want to change the prices. The hyperinflation scenarios that we hear of, like you would buy bread in the morning, in the afternoon the price was already different. You know, it would change so rapidly because of really high changes in price. So that's the menu cost. Any questions so far? The shoe leather cost is maybe less relevant because we don't think about leather being under shoes, but the whole idea, the name where it came from, is that you would wear off your shoes by running to the bank so often. Because if there's high levels of inflation and you have some savings, let's say you have $100,000 saved up, there's high levels of inflation, you don't want to keep that money in the normal bank, just in the deposit account, or you don't want to keep it under your mattress either, because that $100,000 will lose purchasing power every month, every year, as inflation rises if you just keep it as cash. That same $100,000, if there's 100% inflation, will allow you to buy what you used to buy 50,000 years ago, a year ago. So if there's high levels of inflation, and once again, these costs are greater, the greater the inflation, well, if there's high levels of inflation, you're going to keep as much money as possible in things that are sheltered from inflation. So when I think about things that are sheltered from inflation, bonds are not typically sheltered from inflation. There exists some that could be adjusted to inflation, but bonds are not typically sheltered from inflation. If you get into an agreement with a company that they repay you $1,000 in a year's time or 10 years' time, well, that's the amount, regardless if there's 100% inflation in between. That's the amount. It's a fixed amount. It's not normally adjusted for inflation. It exists, but it's not normally the case. But if you buy ownership into a company, you buy a share of a company, well, in that situation, when you buy ownership, you buy a share in a company, well, if there's inflation, every asset that the company owns probably has increased in value. Like you think about, like maybe your grandfather will tell you once, like I bought this piece of property when I was young for $5,000, and now it sells for like $100,000 or like $1 million, whatever. Well, there has been inflation. So if you buy land or you buy different types of assets, they are sheltered from inflation. There are certain assets that are sheltered from inflation. Or you think of gold or anything else as well. So if there's high levels of inflation, you're going to keep. So with high inflation, you keep less money as cash or equivalent, like a checking account. and more money in inflation protected savings, let's say. So you might be thinking, well, how does that relate to shoe leather? Why are we talking about shoe leather? Well, so shoe leather is the whole idea that, let's say, today for me is payday. Like it's every second Thursday, and this Thursday is payday. Well, if we had really high levels of inflation, as soon as payday would arrive, I would take my money, even whether I do it virtually or in person. In the old days, you would do it in person, but now I could do it virtually. I would take what I was deposited. I would pay off whatever I might owe to someone right away, or I would keep a bit of money to buy some food. But every single penny I know I won't be using today, if there's 100% inflation on a daily basis, or like high levels of inflation, we're going extreme here just to get a point across, but if there's high levels of inflation, all that money that I'm not using today to make purchases, I will put it in an inflation-protected savings account, let's say. And this doesn't have to be a savings account, like it'd be stocks and everything else, as I mentioned. But I would put it somewhere where I'm not losing tons of purchasing power on that money. And every time I would need money, so let's say I get my tires changed or whatever else, well then I would go back to the bank and get that money out to make that purchase. And then I need more money, I get it. And next time I get a paycheck, I also deposit it. And I would keep doing this. So in the past, you would run to the bank back and forth. Well, now we're thinking more when we think about all of this is we're talking about transaction costs. If ever you guys have bought financial instruments yourself or through a broker, there is certain transaction fees. If there isn't, because sometimes you could buy a mutual fund that has no transaction fee, well, in those ones you have another form of fee, like a management fee or something else. There's always kind of a transaction cost. Some have less than others, but there's always, and if you think about transaction costs, you can think about the costs in terms of money, but you could also think about this in terms of time. Like imagine now how easy it is that you can get paid and like you might only spend that money next Saturday, and you don't really have to worry that during this time, this money has lost so much purchasing power that it's just becoming almost worthless. You don't have to worry about that. But if that was the case, you'd have to always spend a lot of time like buying and selling these instruments and blah, blah, blah to make sure you don't lose too much purchasing power. So the higher the inflation, the more you would do this and the more time it would take in your daily routine to make sure you don't get screwed over too much by inflation. So these are the two main costs associated to inflation, any inflation. The higher the inflation, the higher these costs are. Once again, later on, we'll also add the costs of letting inflation get out of its target range, and how it can fuel different expectations and how it could be detrimental to an economy. That aspect is an extra cost of inflation, but that's only if it varies greatly and it throws people off in terms of what they expect inflation to be. And just to give you a hint and the kind of idea of how it works is because right now, if ever you work for a good job and you negotiate for your salary for the next 3 years, well, if you have a collective agreement, you're unionized like we are here, you'll probably try to negotiate that every salary level will go up by inflation for the next 3 years. Well, generally speaking, most of those jobs will aim for a 2% yearly rise in the wages, in your salary. But if all of a sudden in 2020, inflation was 10% and we negotiate our collective agreement next year, will we keep negotiating for the 2% that we've been used to, or will we think that 10% is the new norm? Letting it get out of that range makes it dangerous for negotiations and all of the things that ensues after that. And we'll get to that later on. It's just to kind of give you guys an idea of what's expected of that. Regardless, any inflation rate will have these costs. Time costs, menu costs, costs of changing prices. Okay. Any questions so far? So what's the biggest cause of inflation? What creates inflation? Yeah. Printing money. Yeah. So the big thing that you have to remember from all of this is an increase in money. So here we're talking about printed or money supply. You could say like an increase in printed money or money supply will lead to an increase in the price level, which is inflation. And it almost increases by the same percentage. If you look graphically, there's one of the graphs in the notes, and you could see like a bunch of different countries, and you could see the increase in the amount of money that they have in circulation from one year to the next, and the change in the price level from one year to the next. And there's quasi-correlation, like 100% link between the two. So it's very heavily linked. So a typical question that you may encounter on a final exam will ask about talking about fiscal versus monetary policy. We haven't talked about fiscal and monetary policy, but just to kind of a heads up towards monetary policy. Monetary policy will talk about interest rates and money, naturally monetary. And the question will ask whether hyperinflation is possible due to fiscal policy and monetary policy, because we'll see that inflation can happen through an expansionary fiscal or expansionary monetary policy. So just to give you guys a preview, expansionary fiscal policy is either an increase in government spending or a decrease in taxes. Whereas expansionary monetary policy is an increase in the amount of money in circulation through a decrease in interest rates. Well, the answer for that is the only thing that could cause hyperinflation is monetary policy. Okay? You cannot have hyperinflation, sustained hyperinflation caused by fiscal policy. And I'll get back to that later on, and I'll kind of just throw the answer right away, why. But if it's kind of vague to you, don't worry about it. It's not material that will be covered for a few chapters still. But the reason why is expansionary fiscal policy is an increase in government spending or a decrease in taxes. Well, the government has a certain limit that they can do that. They can't just keep on increasing spending and spending and spending and decreasing taxes. Now in COVID times, there has been a drastic increase in spending by governments. But they're limited. You know, like Canada can't just start spending trillions more and trillions more and trillions more if it doesn't change the amount of money that it has by printing more money. So just straight up fiscal policy cannot lead to hyperinflation. Every hyperinflation scenario in history is always due to money. Okay? So different reasons why different countries may decide to print more money. So an example I like to think about is Zimbabwe, which is one of the recent countries that had really, really high levels of inflation. Like if you read on it, it is insane, like the inflation levels. Like it is in the millions of percent or whatever. And it's super, super large. And you have this situation, sometimes you wonder, like, why is it the case that you can have such high levels of inflation? Well, in Zimbabwe and other countries, the story might be a little different. I'm just going to kind of give you guys a hint to why some countries sometimes print money, even though it might not be the best thing for their economy. Well, if we think of a government that wants to spend, and it could be spending on healthcare for its population or on education. But if you're a dictator or you're someone who wants to enrich yourself. It could be spending on yourself and your mansion. It could be just about anything. But government spending needs to be financed by something. That money has to come from somewhere. If we think of a well-developed country, such as Canada, if the government decides to spend more money, where can that money come from? Maybe now, maybe in the future, but where does the government revenue come from to finance its spending? Taxes. Taxation is a major thing in Canada for sure. What's another way that the government can get money to finance its spending? Huh? Resolve?
Reserve, like the extra money they have, like from last year's.
Oh, okay, so if they had extra money from previous years, they had surpluses and stuff like that, yeah. Anything else? Bonds, yeah, so borrowing from the population. A bond is a short-term loan or short-term borrowing that you have from different individuals. Okay, yeah.
Government companies like SIQ.
Yeah, so that's a good point actually. So SIQ or Hydro-Quebec or other government institutions or Loto-Quebec or whatever can generate revenue for the government. Actually it's one I don't normally talk about, but it's true. Yes, there is government entities that do generate money for the government. So if we think of a country, like a poor country like Zimbabwe, sometimes it might be hard to properly tax the population. If you don't have good institutions like we have that make sure that everyone pays their income taxes, it might be harder in countries where it's not as well developed on that front. So you think that in certain countries collecting taxes is easy, in certain other countries collecting taxes isn't as easy. It's not as easy to monitor people, make sure that they're charging sales taxes. It's not as easy to make sure that they're paying their fair share of income taxes. It's just not that easy. So if we kind of remove that way of financing expenditures, then you could think, well, let's go to bonds. Well, if you live in one of those countries that might not be as stable because the person in charge is just kind of very corrupt, and you're someone that has money in that country, you're not necessarily going to use that money and buy Zimbabwe bonds. You might buy government of the USA bonds or other things that are seen as more stable in terms of a stable investment, a better investment. So if it's hard for you to tax the population, it's hard for you to borrow from the population, you might not have institutions that generate revenue within your country. You might have a few, like you might have different raw material companies or diamonds or whatever in your country that generate money. But depending on how corrupt or not, it depends how much money goes to the government on that. So your natural means of collecting money in a developed country are not as easy in certain other countries. So because of that, they sometimes resort to this kind of strategy. Because printing money is known as an inflation tax. Why can I say it's an inflation tax? Because it's not necessarily a tax that I'm taking money out of your wallet, but indirectly I am. Indirectly, you're taking money away from the people when you create a lot of inflation. Why is that? Well, if I'm about to retire and I have a pension fund that has a certain amount of money in it, or I have a bank account with money in it, or I have like my wallet's full of money, whatever. In any of those cases, if I have money and inflation hits, that money that I have accumulated is worth less. Imagine you have $1,000 and 10% inflation hits. What used to cost $1,000 now it costs $1,100. So with your $1,000, you could buy, roughly speaking, what used to cost maybe $900. So it's as if the government came in and took 10% away of what you had in terms of money. It's taking away your purchasing power. It's taking away some of what you can purchase. due to this inflation tax. What you're doing when you increase the amount of money in circulation is you're diluting its value. But if you're the government who needs money, if you print an extra $10 million, and let's say it leads to 100% inflation, 10 million is not that much money, but even though that 10 million is worth the same as 5 million last year, well, if you print it and you keep it for yourself, you're still 5 million better off than before. And if you owe money, well, then you owe less in a certain way, or it's easier off to pay off sometimes with inflation. So it's that kind of tricky situation. But it's just something that we have to make sure that doesn't get out of hand, this monetary policy. So macroeconomics kind of covers the whole economy. And there's a lot of chapters that we cover in this class, and there's a lot of different concepts, and we kind of see them all independently, and then you kind of start seeing how they all kind of fit in and they all come to play together. Well, to give you guys a bit of a hint, we haven't really focused on monetary policy, but we know it has to do with money. And we kind of see now that there's problems of hyperinflation if it's badly managed, if it gets out of hand. And we'll see that deals with letting the inflation get out of hand, and then inflation expectations can make matters worse. We'll see all of that later on. But there's also the idea that we'll talk about exchange rates in the future. Well, there's the idea that a country may want to fix its exchange rate to another country, because when it does so, it gives up its monetary policy abilities. And once again, we're kind of going too far ahead here, but I just want to show how everything's a little linked. And it's giving up that monetary policy makes it that you are kind of like following whatever country you're fixing your currency to, and we'll see how all of that works. But it also makes it safer for you from getting hyperinflation or having these inflation problems in the future. And we'll see why in the past, well, now the UK is kind of going under Brexit, but in all the time that the euro existed, the United Kingdom never adopted the euro currency. And the only reason why they didn't do that, the main reason why they didn't do that, is to keep access to their monetary policy, which is a tool to get out of recession. If ever you're in one, there's monetary and there's fiscal policy are the two main ones, government tools. Then there's how the economy recovers without the government, but those are the ones we're going to see. So that's kind of like just kind of goes all around. It's all linked up. Okay. Any questions up to this point? Because you guys are so silent, I'm trying to see other things in this chapter that definitely worthy in remembering. There's that whole kind of equation that's like MV is equal to PY. The big thing in that whole equation there is if we kind of forget V because velocity is pretty stable over time, well, if we think M is equal to Py, well, if the money in circulation increases by 2% or 3%, but Y, which is our output, also increases by 2 or 3% at same level, it's not going to lead to inflation. So you can increase the amount of money in circulation by a certain amount if production is increasing, but it's when it gets out of hand. So if in this case here, I increase money by 10%, and my output is only increasing by 2%, well, that means that if this doesn't change and this number here goes up by 10%, so let's say it was 100 and now it's 110, well, this number here, which is P times Y, has to also increase by 10%. Well, if this small segment increases by 2, this one has to increase by, relatively speaking, 8%. Okay? So it's that whole idea that an increase in money, if you have like much higher output rates, it doesn't really matter. If they're the same number, it doesn't really lead to inflation. But typically speaking, like the amount of economies in the world that grow at double digits, like 10%, was like China for a certain amount of time, but it's not the case anymore. There's not many countries that really grow that fast, you know. So a country that grows by, let's say, 2% or so is doing pretty well, 2, 3, 4, 5%. So if you decide to increase your money in circulation by more than what that percentage increase in output is in that country, you're definitely leading to inflation. But if it's just a little bit more and you have that 1 to 3%, that's totally fine. For Canada, that's our target, but that's the situation. Any other questions, comments? No? Okay. So when it comes to inflation as well, like inflation on its own is not that bad. Like I said before, it is bad on money holders. But let's say I spend all my money every paycheck every year, and my wages go up by 30%, and everything I buy goes up by 30% from one year to the next every year, I would still have always the same purchasing power. So like that 1 or 2, even if we have 2% inflation, it's not that costly to society if wages adjust in the same direction. Inflation hurts most the people that don't see their wages rise by inflation, or people that are retired, people that have money but don't have any new streams of money that will be adjusted for inflation. It's that kind of person that we're hurting the most. Because if you increase my salary by 50% and you increase the price of everything I buy by 50%, it doesn't really change that much, you know? It's like, if you think of like, if you ever watch stocks, like Tesla like had a stock split this year. Well, if the share used to be, let's say, 2,000 and you had 1 share and now it's 400 and you have 5 shares, it's the same thing, you know, like you have the same ownership in the company. If you sell it all, you have the same value and everything. So it's kind of like that inflation fairy example in the notes. If overnight all the money and all the things you had kind of doubled and everything that you buy also doubles, it doesn't really change that much. I guess the last thing I could kind of cover here is the discussion or thought process is to think, well, why does money really bring up prices? Well, if you think about it, this kind of equation shows it in a certain way. If you imagine this is all of Canada here in this classroom, and we have a certain amount of money, and we have a certain amount of tables, and we have a certain amount of assets, products. Well, if you were to double everyone's income here, the amount of money that they have in their bank accounts, but not change the price of the different goods, there's a lot of things that you would go out to try and buy. Because you're like, oh shit, I used to have like $10,000, I now have like $20,000 or $100,000 because it's gone up so much. But as everyone here is trying to chase those products because everyone here has more money all of a sudden, the price of those products will be propped up. Like it's not true that we'll all be able to buy Lamborghinis or we'll all be able to buy whatever because we all have more money. Because as we all have more money and as we all try to chase the limited products that we have on this planet, in this country, it's going to drive up prices. So that's another way you can see it. Okay? Like imagine like everyone here is working full time and you used to make like $50,000, $100,000 a year, and now all of a sudden you're making like $250,000. Like you'd be going out and you'd be trying to buy everything. But as that happens, there's just so much pressure on those limited goods that the prices will go upwards. And inflation will follow. We can't buy more goods that are actually available. So that's why, like, if ever you had me in microeconomics, when I do the trade example, I focus the trade example on the quantity of goods produced between the different people. Because if you put a price on it and you say, well, if it's cheaper there, we could just buy more. Well, as you buy more, prices change. You know, that like there's other effects that happen. And that's very present here. As more money is in circulation, if there's not more goods around, it's definitely going to lead to driving up the prices of those goods. Last but not least, I guess, later on when we're going to be talking about price level and inflation and the value of a currency. So if ever you get a question relating to a value of a currency, if there is inflation in a country, that $100 bill buys less goods in that country, but it also now allows you to have less of a foreign currency. Okay? Because otherwise it wouldn't make any sense. Imagine that like right now buying this costs like, I don't know, $3. And all of a sudden we have like super high levels of inflation in Canada that this now costs $30 in Canada. So you go like, there's really high levels of inflation. I'm just going to trade my currency to the US and I'll buy it there. And it's cheaper. It wouldn't make any sense. Okay, like we could kind of go through the whole logistics, how it happens. But when there is an increase in price level and inflation, more than another country will have a weakening of that currency. So if you have, let's say we say that increase in price or inflation in Canada is 2% over a year. And then inflation in Australia is 20%. Well, over this same year that we're talking about, that we had this 2 and 20% inflation, we expect the value of the Australian currency to depreciate. Okay, so you could say Canada will gain value relative to the Australian, or Australian will lose value relative to the Canadian. Either way, that's what's going to happen. So as you print more money, you are poorer in terms of purchasing power. You have less purchasing power in your country for imported goods, for any good out there. Your $100 bill is worth less than before. There's no way out. You can't just say, I just won't buy any more Canadian currency. If we have 100% inflation, and now like it's $1.30 to get a US dollar, you could easily see next year being $2.60, double. Because our currency is worth half. If their currency hasn't changed, they had 0% inflation, and we had 100% inflation, and we're now at $1.30 Canadian to $1 US. I don't know if that's what it is right now because no one's traveling anymore, so I don't really pay attention anymore. But we're around there somewhere. Well, if we had 100% inflation, everything's double the price, you could expect that it will be like $2.60 Canadian to get one US dollar. So if ever a question arises that talks about different inflation rates for different country and what happens to how much of that country's currency you can get, well, whichever one had the higher inflation rate will lose purchasing power. So here in Canada, if we used to be able to get, let's say, before we had one Canadian dollar gets you one Australian dollar. I don't know how it's written, AUSD, let's say. And now after this year, maybe one Canadian dollar will get you 118 Australian dollar. There's other things at play naturally. This is not the only thing. Like, don't just think that this is the absolute only thing, but it definitely has a big impact. Okay. If ever you own a company, and we'll talk about exchange rates later on, but like if ever you want to get like a forward or a futures exchange rate, like let's say you know that in 6 months you're going to get US dollars and you want to transfer it to Canadian, and you want to make sure that your costs and those future revenues kind of balance out, or it's the opposite, you get your revenues now because people are paying for the product, but you only deliver it in 6 months. And you want to make sure that currencies don't fluctuate too much, and you get the forward futures contracts on that. They'll often establish at what rate the new exchange rate should be in the future based on inflation rates and other things like that. So it's just a bunch of different concepts that kind of get melted in together. Yeah. So any questions here? So there's a lot of applied things that maybe go a little bit beyond what is expected of you in this class, but I just want to kind of throw you out there and different things that you could kind of learn, different things that you could kind of put together. And if there's no questions, we might end it here. I have a meeting that I kind of missed the beginning, so I'll jump in on it. But I'm happy to help out if anyone has one-on-one questions. Just come see me, and otherwise I'll see you guys next week. Have a good weekend.